Good morning, friends. My name is Anup Nigam. I'm a technical analyst. In the previous video, we learned about how do we calculate the profit or loss of the long call option. Now, in this video, we'll try to understand how do we calculate the profit or loss of the short call option. Call option is basically an instrument that gives the trader right to buy an underlying asset by a certain date for a certain price. So for selling the option, the writer or the seller of the call option charges the premium from the buyer. The profit or loss that the buyer makes on the option depends on the spot price of the underlying asset. So whatever is the buyer's profit is the seller's loss. So if upon expiration the spot price exceeds the strike price, the buyer will make the profit whereas the seller will make the loss. Higher the spot price, more is the profit for the buyer, whereas more is the loss for the seller. If the spot price is below the strike price at the time of expiry, the buyer lets the option expire worthless, or in other words, the buyer does not exercise the option. And in that case, the writer or the seller gets to keep the entire premium. So the buyer's premium becomes seller's profit in this case. Let us say the trader sells the call option of strike price 2250. So when the trader sells this call option of strike price 2250, he's likely to buy this call option back at a future date at an unknown price. So when we sell the call option, it refers to as the short call. So if the spot price goes up, the seller makes the loss. But if the spot price remains below the strike price, then the seller makes the profit. Now we'll try to understand how do we calculate the short call option contract profit. So if the seller sells a call option of strike price 2250 of a stock X at a premium of 100, and if the premium goes down to 95, and if the stock X has a lot size of 1000, so the seller makes a profit of 5 rupees in this case. So 5 multiplied by 1000, that means 5000. So the seller's profit would be 5000 rupees in this case. Now let us see the example of the loss also. So if the seller sells a call option of strike price 2250 of stock X at a premium of 100, and if the price goes up to 105 and the lot size is of 1000, then again the trader will make the loss of 5000 rupees. Now there is third scenario also. Let us say the seller sells a call option of strike price 2250 of stock X at a premium of 50. So if at the time of expiry the spot price remains below the strike price, then the buyer does not exercise the option. That means he lets the option expire worthless. And if this stock X has a lot size of 100, so in this case the seller would have the profit of 5000. That means the option premium that the buyer paid to buy this particular call option. So let us try to understand this with the help of graph. So if the seller sells the call option of strike price 2250 of stock X at a premium of 100, so if the spot price remains below the strike price, that means the seller will make the profit up to the tune of option premium. But if the spot price goes above the strike price, then the seller will start making the loss. So guys, in this video we have tried to understand how do we calculate the profit or loss of the short call option. So if you think that this video is informative, then please like this video and subscribe my channel and share this video with as many traders as you can. Thank you. Dhanyavad.